requirements. Will you recommend the Job Guide 360 interview guide to prospective job seekers?
Sure, I will. The guide is detailed and very comprehensive.
Welcome to the Deep Dive. Today we're diving into a really critical area of finance, Treasury management. It demands, well, incredible precision, a global view, and frankly, nerves of steel.
It really does.
We're using a guide today, a sort of blueprint for the modern Treasury Manager, to pull out the strategic knowledge you really need in this high-stakes field.
Yeah, and it's about understanding how this role has, evolved. It wasn't always seen this way. People thought of Treasury as just counting the cash.
Right. Administrative.
Exactly. But now, the Treasury Manager, or TM, is like the company's chief navigator. They're ensuring liquidity, handling global volatility. They're a strategic partner for profit and stability.
Absolutely. And this blueprint we're looking at, it really breaks down. It shows the TM's job is built on, say, 3 pillars: managing the day-to-day cash, doing rigorous risk assessment, and driving that long-term financial planning. It's not easy. You need serious financial skills, strategic thinking, leadership, and you've got to know the software.
Totally. And if you're listening to this, you have to get the technical stuff. That's just the entry ticket.
Right.
The real value add is being able to take all this complex information market trends, regulatory changes, geopolitics stuff that often seems contradictory, and synthesize it in real time. Turn it into decisions people can act on.
Okay, so our goal today is to give you that strategic insight. We'll distill the key strategies, map out the regulatory hurdles, talk about the leadership stuff. Let's start right at the heart of it, managing cash and liquidity.
Okay. So everything starts with cash flow. I mean, the health of any company, right?
Yeah.
And the absolute foundation for Treasury work is detailed cash flow forecasting.
Right.
The guide really hammers this home. It's crucial for strategic planning because, well, if you don't know where the cash is going to be, how can you make smart investments or manage debt properly?
Okay, forecasting sounds good, but markets are volatile. How does this blueprint suggest TMs stop their forecasts from just being, guesswork? How do they handle the uncertainty?
That's the million-dollar question, isn't it? It has to be dynamic. You can't just set it once. The technique is a blend. You look at historical data for a baseline, but you combine that with aggressive market forecasting. You adjust for things you expect, like sales cycles changing or maybe supply chain issues, plus external economic stuff. A good forecast is alive. It's updated, daily or weekly.
And that flows right into the classic Treasury challenge, balancing liquidity and profitability. You need cash, handy, liquidity, but idle cash. That just sits there earning zip. It hurts shareholder value.
Precisely. That's the tension, always. And the solution isn't just one thing. Sure, you need a strategic liquidity buffer for, surprises.
Right, the emergency fund.
Yeah. But the real skill isn't optimizing working capital, managing receivables, payables, inventory, that whole cycle.
Okay. So getting more surgical, not just collect money faster. The TM looks at the whole picture. Maybe stretch payables a bit carefully.
Right, without wrecking vendor relationships.
Or working with operations to, say, turn inventory faster.
Yeah.
Because inventory sitting there is just tied up cash.
Exactly. Every single day counts. And then, if you truly have excess cash, the key is smart short-term investment. This isn't growth capital, it's cash waiting. So, low risk, easy to liquidate, short-term stuff. It earns something until you need it. Supports liquidity and profitability.
Okay, let's stress test this. The ultimate TM test. A cash flow crisis, boom, unexpected shortfall hits, maybe a big customer defaults. What's the immediate playbook?
First step has to be rapid assessment, like right now. What cash do we have? What absolutely has to be paid soon? You triage payments, critical payroll, utilities versus non-critical. Prioritize like crazy. And at the same time, it's crisis leadership time. You're reaching out, talking to key stakeholders.
It's negotiations, basically. The guy mentions talking to banks, major creditors, try to rework payment terms, maybe get emergency funds. You need breathing room.
Absolutely. Buying time is critical. And other quick actions. Tighten credit controls immediately. Stop extending credit to risky customers. And if you can, draw on or quickly arrange a short-term credit line. It's damage control and getting liquidity fast.
Got it. So once the fire's contained, the focus shifts to making routine stuff smoother. That brings up managing intercompany transactions, especially in big multinationals with subsidiaries everywhere.
Yeah, that can be a huge operational headache, but also a huge potential win for efficiency. The strategy here is usually centralized treasury management.
Centralization, okay.
Because that lets the company use intercompany netting systems, which are actually pretty elegant.
Reduces the sheer number of transactions, right? Instead of, 20 payments crossing borders between subs.
Exactly. You might net it all down to just 1 or 2 final payments. That cuts bank fees way down, lowers your FX exposure, and, importantly, helps ensure tax compliance across the board.
Okay, so complexity and risk.
Yeah.
They just skyrocket once a company goes international, don't they?
Oh, absolutely. We have to talk about global financial risks. Especially currency fluctuations, that's a massive threat.
It hits everything, right? Profit margins, how you price things globally, even the value of assets on the balance sheet. The example in the guide is pretty clear. U.S. company earns revenue in euros, but most costs are in dollars back home.
Yeah, classic scenario. If the dollar suddenly gets stronger against the euro, boom, the value of those euro revenues just shrinks when you convert them back to dollars.
Profit margin takes a hit instantly, even if sales volume is the same.
That's transactional exposure smacking the bottom line. So, to handle this FX risk, the TM needs solid techniques. Step 1 is really understanding your exposure. Analyzing transactions, looking at balance sheet items in foreign currencies, assessing the broader economic risk from long-term currency shifts.
You got to measure it first.
You have to. Then, once you've quantified it, you move to hedging. The guide mentions specific strategies. Forward contracts are common, lock in a future rate. Or options, which give you the right, not the obligation, to trade at a certain rate.
So flexibility versus cost.
Exactly. Depends on your market view and how much you want to pay for that protection.
And if we zoom out from FX to general global risk, it's not just currency. Interest rate changes can be brutal. Geopolitical instability, think sudden tariffs, political chaos.
Right. All major risks. So the TM uses a mix of tools. There's quantitative stuff like VAR models, value at risk, which estimate potential losses.
Sort of a worst case scenario calculation.
Kind of, yeah, within certain probabilities. But you combine that with qualitative judgment, ongoing market research, country risk reports. You need both.
And the key thing here seems to be continuous reassessment. You can't just set your risk strategy and walk away.
No way. It has to react. A central bank hikes rates. Political crisis erupts somewhere you operate. You need to adjust, potentially fast.
That continuous monitoring must apply to debt management too.
Definitely. Strategic debt management means structuring it smartly, finding the right mix of short-term and long-term borrowing to match your cash flow forecasts and investment plans.
And when rates do change significantly, especially if you have variable rate loans,
those are exposed immediately.
what's the response then?
It has to be comprehensive. First, review all your loan agreements, the covenants, the terms. Then look at strategic moves. Can you refinance? Is it a good time to switch variable loans to fixed rate, lock in a cost, get rid of that uncertainty? It's all about proactive cost control.
Okay, let's shift gears a bit from market chaos to regulatory reality. Knowing this stuff is one thing, but applying it, compliance with all these financial rules is just non-negotiable, isn't it?
Absolutely imperative, not just for integrity, but avoiding huge penalties, even impacting your banking relationships and costs.
So this is where solid corporate governance in Treasury is like the bedrock.
It's the backbone, yeah. The basics are clear policies, who does what, who has authority, effective internal controls to stop operational mishaps, and regular tough audits, internal and external, to keep data accurate and systems honest. Strict adherence to the law, obviously.
Let's get specific though, because some of these international rules have a massive ripple effect. Basel III, for instance.
Right, Basel III, it's an international banking regulation. The main point is making banks stronger, more resilient. It forces them to hold way more capital in reserve and have more stable, long-term funding.
Okay, but why should a corporate treasurer care deeply about bank regulations? What's the direct impact?
Because if banks' costs go up and they have to hold more capital against loans, guess what?
Costs get passed on.
Exactly. Corporations might see higher banking fees, maybe credit gets tighter, lending standards get stricter. So the TM's response has to be build up those liquidity buffers even more and diversify funding. Don't rely too heavily on just 1 or 2 big banks.
Got it. Okay, different angle, but also complex.
Yeah.
IFRS 9, specifically hedge accounting. This sounds technical, but it's vital for public companies.
Oh, it's absolutely critical for compliance. Under IFRS 9, your hedge accounting has to directly match your stated risk management goals, and you have to prove the hedge works.
Prove it. How?
Through effectiveness testing, at the start and continuously. Show it's actually offsetting the risk you say it is. If you can't prove it's effective, you lose hedge accounting treatment, and bam, your earnings get much more volatile on paper.
Wow. Okay. And then there's the foundational stuff. Anti-money laundering. AML policies.
Can't operate globally without robust AML. It means ongoing risk assessments where the vulnerabilities, continuous staff training spot suspicious activity, report it, and constantly updating your strategies as regulations change, especially around cross-border payments and knowing who the ultimate beneficial owner is.
Managing all this, the governance, the risk, the global transactions.
Yeah.
It seems impossible without serious tech nowadays.
Oh, it is. Absolutely impossible manually. You need specialized financial software. Starts with the big ERP systems, SAP, Oracle. They're the main database for operational data, invoices, sales, inventory.
The source of truth.
Right. But then you layer specialized treasury management systems, TMS, on top, like Curiba or FIS Integrity.
And what does the TMS do that the ERP doesn't?
It handles the really specific treasury stuff, connecting to all your banks automatically, calculating your daily cash position, managing complex debt instruments, modeling financial risks, all in one place. And the big game changer now is data analytics.
Yes.
We're talking predictive analytics, using data for truly forward-looking management, tracking cash flow trends to improve forecasts, evaluating complex risks more precisely, even using analytics to spot weird transactions anomalies that might signal errors or even fraud.
All right, let's pull back to the bigger picture again, the strategic role, moving from being counter to strategic partner.
Exactly. The Treasury Manager plays a key role in shaping the company's capital structure, finding that optimal mix of debt and equity. And this isn't just an accounting task.
No, it impacts everything.
Right. It's about lowering the overall cost of capital, maximizing shareholder value. It means analyzing debt levels, cost of capital, what the market will bear, maybe taking on more debt if rates are good, or looking at alternatives like convertible bonds for flexibility.
And that strategic input must be absolutely vital during M&A, mergers and acquisitions.
Oh, critical. When companies combine, treasury strategy is front and center. Starts with deep due diligence on the target's debts, cash situation.
Looking under the hood.
Thoroughly. And then post-merger. It's all about rapid integration, managing the combined debt, maybe renegotiating terms, harmonizing all the cash management systems and policies to actually get those cost savings the merger promised.
Okay, so you're making these huge, complex decisions, FX hedges, capital structure, M&A integration. How does the TM explain this stuff effectively, especially to executives or board members who aren't finance gurus?
Yeah, that's a huge soft skill, right?
Yeah.
Simplifying the complex. The guide had a good illustration. Imagine the CFO asks why profits dipped, and the TM needs to explain FX risk without just throwing jargon around.
Right, make it understandable.
The successful TM, like in the anecdote, uses analogies. Simple graphs, clear charts, they break it down. Don't just say the euro weakened. Show how that means fewer dollars per sale. That helps everyone make informed decisions.
Makes sense. And finally, these are high-pressure jobs. Crisis can hit anytime. Does the guide mention tools TMs use for just managing the pressure? Staying organized?
It does. Practical stuff. Like the Eisenhower box, that urgent important matrix helps prioritize tasks when everything feels urgent. And using agile type practices for recurring tasks, like making sure the daily cash position gets done perfectly, while still freeing up time for the big strategic thinking, like modeling that next capital structure tweak. Hashtag tag outro.
Wow. Okay, so we started by saying the Treasury Manager role is deeply strategic, and I think this whole discussion really underlines that. It's leadership across global risk, complex regulations like Basel III, IFRS 9, strategic finance, crisis management. Adaptability seemed key.
Absolutely. The modern TM is maybe a specialist generalist, always adapting strategies to meet new rules, learning new tech skills, maybe mastering visualization tools like Tableau or Power BI to make their reports more impactful.
Yeah, that communication piece again. The challenge today is managing all that complexity, balancing the immediate need for cash with long-term profit goals.
It is. But here's the final thought, maybe a challenge for you listening. Look beyond today's rules, beyond Basel III or IFRS 9, given how fast markets and tech are moving. What do you think the next big regulatory shift will be? Or the next tech disruption? The thing that forces treasury managers to fundamentally upskill or rethink how their whole department works? Because that kind of foresight, well, that's the ultimate mark of success in this field, isn't it?